When people hear the phrase algorithmic trading, they immediately picture traders, charts, screens, stress, constant decisions, and because of that, a lot of people assume algorithmic trading just isn't right for them. But here's the truth. Algorithmic trading isn't just about how trades are placed. It's about where algorithms fit inside a portfolio. And depending on your goals, your risk tolerance, and how you might think about money, algorithms can play very different roles. So in this video, I'm going to break down the three main ways that investors actually use algorithmic trading in very simple terms so you can clearly see where you fit. You might fall into one of these three categories and you might fall into a combination of all of them. But once you understand this framework, algorithmic trading stops feeling complicated and starts feeling intentional. Now, before anything else, the first thing you need is a plan. See, before anyone considers algorithmic trading, they need to have a plan. I'm not talking about a strategy or software or settings. I'm talking about a plan. And that plan can be mindset. It could be a role that algorithms play in your portfolio or a structure across multiple accounts, because algorithms are simply just tools. And tools only work well when they're used for the right job. Now, almost everyone we speak to naturally falls into one or a blend of all three of these mindsets. Mindset number one is the diversifier. This is where most people start. These are investors who already have a long-term portfolio. They may own stocks, they may own real estate, maybe some bonds, and maybe a little bit of crypto such as Bitcoin or Ethereum, but there's something missing. They don't have anything that's actively participating in the markets, taking advantage of different conditions, generating returns independent of traditional assets, and at the same time, making sure that they're not the ones having to actively manage the trades. See, the diversifier doesn't want to watch charts. They don't want to make decisions every day, and they don't want a second job. The goal simply isn't to swing for the fences. It's to add an uncorrelated return stream to their portfolio. So something that behaves differently than stocks and real estate, something that can operate in up markets, down markets, and choppy markets. And this mindset is really about portfolio stability, not excitement. Now, the problem that most of these investors face is that most long-term portfolios are heavily correlated. So when markets go up, everything feels great. But when markets stall or decline, everything slows down and crashes at the same time. And that's where diversification really matters. Not owning more things, but owning things that behave differently. So in this role, algorithmic trading actually acts as a supporting asset. It's not the star of the show. It's not replacing all your assets. It's the smooth ride that you can add to have consistency over time. And so for these investors, algorithms can be more of a stabilizer rather than a gamble. Now, the second type of investor is the alpha investor. This group looks at algorithms very differently. They're not just trying to stabilize the portfolio, they want algorithms to materially move the needle. So these investors typically allocate more risk capital, they run multiple accounts and multiple strategies, and they adjust risk settings intentionally. And actually, they enjoy understanding how the systems work and they geek out on this stuff. So they're intellectually engaged. They're typically wanting to figure out how different risk profiles perform, how the same algorithm behaves under different settings, how technology can be optimized inside their portfolio, all for one main reason. The main reason is to see the portfolio grow and not have reckless growth, but intentional controlled upside. So instead of them asking, how safe can this be? They're typically asking, how much return can I responsibly target with this portion of my capital? Now, with these two types of investors, sometimes there's some in-betweeners. And the biggest mistake that investors that are in between make is trying to force one account to do everything: stability, growth, and income, and that usually doesn't work. So this mindset of the alpha investor is great for using segmentation with your risk. You can have the same algorithm, but just simply in different accounts, different risk settings, and have things compound differently. So for example, one account can be focused on consistency, one account can be more aggressive, and one account can be really pushing performance. That creates diversification within the algorithmic allocation itself. And this is where education, onboarding, and understanding risk parameters really matter, and how we help our clients do so is once they get started, we walk them through all of these things and figuring out exactly which strategy is best for them. Now, the third type of investor mindset that we have here is the cash flow strategist. See, this group thinks very differently. They're not asking how big can this account get, they're asking how can I use this to support my lifestyle or my business. See, these people already have capital. They may own multiple businesses or entities, but what they really want is predictable monthly withdrawals. And so, really, the goal here for these types of investors is cash flow. They're not necessarily looking for compounding, they're not looking for aggressive growth, they're just looking for consistent output. Now, the problem for these types of investors is that some assets are really great for long term and terrible for monthly income, so they typically take on real estate. But real estate takes a lot of time, takes a lot of energy, and typically the cash flow can be minimal unless you're in a massive property. On top of that, markets fluctuate, interest rates rises and falls, and many assets don't really distribute predictably. And that can be frustrating when you want your money now rather than later. And so within this mindset, algorithmic trading is used like an income engine. Capital is deployed, profits are withdrawn regularly, and the account stays relatively stable. Instead of reinvesting everything over and over and over, this investor consumes the output, which can be used for lifestyle expenses, paying down debt, funding other investments, or running a business. So once this investor actually sets up the algorithm, they go and do their thing with their businesses, their properties, or any other thing else that they got going on. And then they come back and they just withdraw the profits that happen on a monthly basis and typically treat it as cash flow. But here's the most important part of this video. You don't have to just choose one type of investor mindset. See, this is where most people get confused. These aren't rigid boxes per se. A lot of our clients actually start as diversifiers, then they grow into alpha investors, and then they make a cash flow account after seeing some results from some of the strategies. And to be clear, the strategy follows the role, not the other way around. And that's why conversations matter, because the right structure depends on your goals, your capital, your timeline, and how you really want this to fit into your life. So see, algorithm trading just isn't one thing. It's a tool, and tools work best when used intentionally. So if you're considering algorithmic trading, the real question isn't what strategy should I use? It's what role do I want this to play in my portfolio? And if you want help figuring that out, whether you're a diversifier, an alpha investor, or a cash flow strategist, or a combination of the three, you can click the link in the description and book a call with my team. We'll walk you through your goals, explain how these structures work, and help you decide what actually makes sense for you. So if you like this video, go ahead and be sure that you're subscribed, and I'll see you in the next video.